All right, so our next topic is profitability ratios. This is our next type of ratios, which measure the ability of the company to generate profits from its sales. So, if we look at the income statement of any company, so for example, we we can look at the income statement of Coca-Cola. There is a particular revenue they are generating, uh, which is increasing year on year. But then there are different measures of profit we are looking at: gross profit, operating income, profit before income tax, profit after tax. So there are various profit measures with respect to revenue, right? So how much profits the company is able to generate from its revenues will be a lot dependent upon uh, how well the company is managing their costs, right? So uh, from the same revenue, two companies can generate different profits depending upon how they are managing their costs, how they are managing their expenses. Profitability ratios are financial measures that gauge a company's proficiency in generating profits relative to its revenue, assets, equity, or other financial parameters. So, we were talking about revenue, but it could be with respect to assets. What is the profit? What is the returns you are generating with respect to equity or other financial parameters? These ratios offer a window into the company's overall financial performance and efficiency, right? So, uh, these are like your return ratios, or these are like your profitability ratios, what the company is able to generate as profits or as returns with respect to the revenue they earned, with respect to the assets they are using, with respect to shareholders' equity, etc. Profitability ratios hold substantial significance in appraising a company's financial well being and its ability to yield returns for investors and shareholders. They facilitate comparisons of a company's profitability with peers in the industry and historical performance. There are different profitability ratios such as gross profit margin, operating profit margin, net profit margin, return on equity, return on assets, return on capital employed, and return on invested capital. So let's look at all these profitability or return ratios one by one. First, we have gross profit margin. It is a fundamental profitability ratio that assesses the percentage of gross profit related to a company's total revenue. So, what is the gross profit the company is able to generate from its revenue? Gross profit is calculated as uh, revenues minus cost of goods sold. So, whatever is the direct cost involved in producing those goods which were sold during this period, we remove that from the revenue to get our gross profit. So that's why it is known as gross profit margin. Interpretation is gross profit margin signifies the proportion of revenue retained as gross profit after accounting for expenses directly linked to the production or purchase of goods. A higher gross profit margin indicates effective control of production costs and greater efficiency in generating profit from core operations. Conversely, a lower margin may suggest higher production costs in comparison to revenue, potentially impacting overall profitability. So, better we are able to manage our direct costs uh, if we have higher control on our direct cost, if we can reduce those, that will impact our gross profit margin in a positive way. That will increase our gross profit margin, and it is a measure of efficiency in terms of managing the production costs, direct production costs. Uh, So, if we are comparing the companies within a particular sector, higher the gross profit margin for a company, the better it is. Next, we have operating profit margin. It is a fundamental profitability ratio that assesses the proportion of operating profit concerning a company's total revenue. Operating profit margin is equal to operating profit upon revenue into 100. So, what is the operating profit we are able to generate from our revenues? So, that means from the revenues after deducting the cost of goods sold, after deducting the operational expenses like general administrative expenses, selling marketing expenses, research development expenses, after reducing these operational expenses, what is the profit left? That is my operating profit divided by revenue into 100, we get the operating profit margin. Interpretation: operating profit margin reveals the segment of revenue that remains as profit generated from essential operational activities. A higher profit margin signifies a company's adeptness in efficiently handling operating expenses and deriving profits from its primary business operations. Conversely, a lower margin may suggest higher operating costs relative to revenue, potentially affecting overall profitability. So, how well we are able to manage the operational expenses, the company having a better control, better ability to manage, to limit the operational expenses, will be able to show higher operating profit margins if we compare it with other similar companies in that industry. So again, within industry, within a similar set of companies comparison, uh, higher the operating profit margin, the better it is. Next is net profit margin. Net profit is after we have taken care of all the expenses, right? So now we are not just talking about COGS or operating expenses, um, other taxes, interest expense, everything once we have accounted for, what is left as profit after tax, that is our net profit. Uh, that that value with respect to revenue is known as net profit margin. It is a crucial profitability ratio that assesses the proportion of net profit concerning a company's total revenue. Interpretation: the net profit margin represents the segment of revenue that remains as profit once all expenses have been subtracted. Okay, so all expenses have been subtracted. What is left as profit after taking care of everything is known as net profit. A higher net profit margin indicates a company's effectiveness in managing all costs, including operating expenses, interest, and taxes, resulting in a robust net profit. Conversely, a lower margin may suggest that expenses are comparatively higher in relation to revenue, potentially affecting overall profitability. So, again, it is a way to capture how efficiently we are able to manage our expenses, our costs. Uh, if if that is controlled better, that company will be able to showcase higher net profit margin as compared to other companies in the same industry. Next is a return ratio, return on equity. Okay, so what is equity? That is, we are talking about shareholders equity here. So using that shareholders equity, using those funds, what is the return we are able to generate? So again, higher it is, better it is. Return on equity is a fundamental profitability ratio that assesses a company's capability to generate profit concerning shareholders equity. So using the shareholders equity, how well, how much the company is able to generate returns. Now, because we are talking about equity, yeah, so that's why in the numerator we are taking net profit as our numerator, because net profit is what belongs to shareholders, because we have already taken the impact of interest or debt out. So that's why whatever is left as net profit belongs to equity holders. Uh, Either we can distribute it as dividends or we can retain it within the company for its future growth. That's the decision of board of directors of the company. But we can calculate return on equity as net profit upon average equity into 100. Interpretation: ROE indicates the percentage of net profit produced for each dollar of shareholders' equity. So using each dollar per dollar of shareholders' equity, what is the profit the company is able to generate? A higher ROE suggests the company's efficiency in utilizing shareholders' equity to yield profit. A lower ROE may imply lesser profitability or less effective use of equity. So again, if we are doing a comparison within the industry, the higher this ratio, the better it is. So this is return on equity. Next we have is return on assets, which is an essential profitability ratio that evaluates a company's capacity to generate profit concerning its total assets. So now we are not just talking about equity, we are talking about total assets. What are the returns the company is able to generate using its total assets? One of the ratios, if we remember, was asset turnover ratio. So there we were talking about revenue upon total assets, but here we are talking about return on assets and we are talking about profits with respect to total assets. So return on assets is net profit upon average assets into 100. Again, if you look at it, it's a mixed ratio with the numerator being an income statement item for the period and the denominator is a balance sheet item at a point of time. So we have to synchronize it, we have used the average of the balance sheet item, average assets, so that it also reflects a value for a period. So that's why it is calculated as net assets upon average assets, net profit upon average assets into 100. This is telling us what are the returns, what are the profits the company is able to generate using its average total assets. Interpretation: ROA indicates the percentage of net profit produced for every dollar of total assets. So for every $1 of total assets, what is the net profit the company is able to generate? That is captured by return on assets. A higher value signifies the company's efficiency in utilizing its assets to generate profits, and vice versa. A lower value may suggest lower profitability or less effective utilization of total assets. Next ratio we have is return on capital employed. Here we are talking about both debt and equity. Okay, return on capital, total capital employed, which includes debt as well as equity. So it is a fundamental financial metric that evaluates a company's ability to generate profit relative to the capital invested in its operations. Now, if you look at the formula, in the denominator, we are using equity plus debt. That means total capital employed is the denominator. That's why in the numerator also we are talking about those returns, those profits which belong to both debt and equity. From EBIT itself, we pay to debt holders in the form of interest expense, and the remaining goes to equity holders as net profit. So on EBIT, both have the claim. So that is why we are using EBIT here, whereas in return on equity, we were only using net profit because there we were just talking about shareholders' equity. So in the numerator, we were using only net profit. But here, in case of return on capital employed, in the denominator, we are talking about both debt and equity. And hence, in the numerator, to synchronize it, we are using EBIT, a return measure which belongs to both debt and equity. Interpretation: ROCE signifies the percentage of profit generated for each unit of capital employed in the business, considering both debt and equity. Higher value demonstrates the effective utilization of capital to generate profit, highlighting the company's profitability. Lower value may indicate lower profitability or less efficient utilization of the invested capital. So again, when we are comparing these values, we should do it for particular industry, and within that particular industry, we can look at different companies. For example, if we pick up IT industry, we can compare these values for TCS versus Infosys versus HCL Tech versus Wipro, etc. So all the major players of IT we can take in the Indian industry, and then we can compare these ratios. We can compare ROE for different companies, we can compare ROA, ROCE, so it will make sense within the same industry. Next we have is return on invested capital. So invested capital means we have provided the capital, but has the company invested it in the form of working capital or long-term assets? Is the company utilizing the capital it is provided? So here we are talking about debt plus equity minus cash. So whatever the company has not yet invested, that is still sitting as cash in the balance sheet, we are deducting that. So whatever is the invested capital, that is debt plus equity minus cash, what are the returns we are able to generate on that invested capital, that is captured through ROIC. It is a fundamental financial metric that assesses a company's capacity to generate profit concerning the capital invested in its operation, taking into account its financial structure. It is calculated as NOPAT divided by average equity plus debt minus cash. Interpretation: ROIC indicates the proportion of profit generated for each unit of capital invested in the business, considering equity, debt, and the impact of cash holdings. A higher value indicates effective capital utilization, resulting in enhanced profitability even when considering the company's cash reserves. A lower ROIC may imply lower profitability or less effective use of the invested capital, factoring in cash holdings. Okay, so again, just like we were doing return on equity, return on assets, return on capital employed, we have one more measure here, return on invested capital. Okay, so various return measures can be used to get a comprehensive picture of what are the returns the company is able to generate using its assets, using its equity, etc. Right? So when we are doing a detailed ratio analysis, profitability analysis, return analysis, then we should look at multiple ratios such as these, and then we can get a very clear picture of where does this company stand as compared to its competitors. Next, we have Dupont analysis. So this is further analysis of ROE, right? So what we do here is we break down ROE into different components to figure out what drives ROE. Okay, which factor is resulting in the increase of ROE or decrease of ROE? That is what we can figure out by breaking down ROE into three components. And when we do that, 3 components, 5 components, when we do that, what we call it as Dupont analysis. It is a financial assessment approach that dissects a company's ROE into its primary components, offering deeper insights into the factors influencing a company's profitability. So which factors are influencing the ROE? That we can figure out by doing a more detailed analysis known as Dupont analysis. Elements of Dupont analysis include net profit margin, which we have discussed. It evaluates the proportion of profit retained after all expenses, encompassing operating cost, interest, and taxes from each dollar of sales revenue, which is calculated as net profit upon revenue, into asset turnover ratio. Asset turnover ratio measures the efficiency with which a company deploys its assets to generate revenue, calculated as revenue upon average total assets, into financial leverage, which examines the impact of financial leverage or ROE by assessing the relationship between average total assets and average shareholders' equity. So this is calculated as average total assets upon average shareholders' equity. If we multiply all these three, what we get is net return on equity. Okay. So if we look carefully, net profit upon revenue multiplied by revenue upon average total assets. So this ratio multiplied by this ratio multiplied by this ratio, effectively it becomes net profit upon average shareholders equity, which is nothing but return on equity, right? So net profit upon average shareholders equity can also be calculated through multiplication of these three ratios. And once we do that, we get a very clear picture of what is impacting ROE. Is it the net profit margin? Is it the asset turnover ratio? Or is it the financial leverage? Let's take an example. When ROE is going up because net profit margin is going up, keeping other two constant. So that's a good sign. If net profit margin is going up and that is why ROE is going up, it's a good sign. Company is able to generate more profits. Company is becoming more operationally efficient. Let's assume case 2 where net profit margin and financial leverage are the same. Asset turnover ratio is going up. So if asset turnover ratio is going up and that is why ROE is going up, that is also a good sign, because that means the company is able to more effectively use its assets to generate revenues. So that's also a good sign. But in case net profit margin is same, asset turnover ratio is same, but the financial leverage is going up and that is why ROE is going up, that's not a good sign. Financial leverage going up means company is relying more and more on debt financing for its operations. That can make the company more financially risky. That can question the sustainability of the firm. That will not be taken well in terms of solvency of the company. So that's what we get to know through Dupont analysis, which factor is making the ROE go up or down. If it is net profit margin or asset turnover ratio due to which the ROE is going up, it is a good sign. But if financial leverage is contributing to greater ROE, that is not a good sign from long-term perspective. That is what we can figure out through Dupont analysis of ROE. Its application: Dupont analysis is a valuable tool for appraising a company's financial performance, strategic decisions, and opportunities for enhancement. Investors and analysts employ it to gain a deeper understanding of the origins of a company's ROE and its competitive standing within the industry. We have discussed these points. Interpretation: Dupont analysis dissects ROE into three fundamental components, facilitating the identification of the drivers affecting a company's profitability, evaluating net profit margin, asset turnover ratio, and financial leverage allows for the pinpointing of factors contributing to the growth or decline in ROE. So we cannot directly say that ROE going up is a good sign. What we need to figure out is what is letting to ROE going up. If it is financial leverage, it is not actually a good sign, right? So let's say NPM and asset turnover ratio is more or less the same. It is the financial leverage which is contributing to the growth in ROE. Financial leverage is going up. In that case, we cannot say ROE going up is a good sign, because financial leverage can make the firm risky and bring into question the sustainability of the firm in the long term. So uh, again, that is the use of Dupont analysis. It lets us know exactly which component is resulting in the movement of in the growth or decline of ROE. Let's look at some workings now. So we are talking about various profitability ratios. Let's calculate. How do we calculate gross profit ratio? Gross profit upon revenue. So gross profit ratio is going down. That means company is not very effectively managing its direct costs. The direct costs are going up faster than the revenue going up. So effectively, the gross profit margin is declining, which is not a good sign. The company needs to take care of its direct cost of production in a more efficient manner. Operating profit ratio is operating income upon revenue. This is more or less similar, going up then going down, but staying within that close to 20-25 range. Net profit margin is net profit divided by revenue. Okay. Next we have tax rate. Let's see the tax rate, which is tax upon PBT. Interest coverage ratio is EBIT or interest expense, which is very high. That means company has a very high capability to service its interest. Company can easily service its interest expense through the operating profits it is making. So very solid rate value here. SG&A as percentage of revenue we can calculate. So we can say 25%, 17%, 14%, 13, 12. This is the percentage of revenue eaten up in the form of SG&A, right? So declining trend means the company is relatively spending less on SG&A over a period of years. They are not uh, increasing SG&A in proportion with revenue. Okay. R&D as a percentage of revenue. Is close to 6 to 8%. Lastly, depreciation and amortization. So all these things we can calculate as percentage of revenue to get an idea of how much of the revenue, what percentage of revenue they are spending on different operating activities. Let's look at some of the return ratios now. Return on equity. Equity. So net profit belongs to equity shareholders. So we'll do net profit upon average shareholders' equity. Which is coming out to be close to 26%. And it is going up, so that's a good sign. Again, we can further break this down into three components, which we'll do through Dupont analysis and figure out which is contributing more to increase in ROE. Return on assets is net profit upon average assets. Return on capital employed is EBIT upon debt plus equity. Average of debt plus equity. Return on invested capital is EBIT into 1 minus T, that is no PAT, net operating profit after tax, upon average of equity plus debt minus cash. Average of debt plus equity minus cash. Debt plus equity minus cash. For last year also, debt plus equity minus cash. Okay, so these are the return ratios. We are telling us the company's effectiveness in terms of generating returns using its average shareholders equity funds, average assets, average capital employed, average invested capital. More or less these ratios are going up, so that means company is more effectively using its assets, equities, capital employed and invested capital to generate more and more returns. So that's a good sign. Now let's break down ROE into further components. That is, let's do the Dupont analysis of ROE, where we break down ROE into three components: net profit margin, asset turnover ratio, and financial leverage. So let's do that. First, let's directly calculate the ROE first. Net profit upon average shareholders' equity. Let's just look at net profit here. So this is the net profit, then average of shareholders' equity. And if we divide these two, we get return on equity. So we have calculated the return on equity. Now let's break it down through Dupont analysis. What we'll do, we'll break it down into three components, which is net profit margin, asset turnover ratio, and equity multiplier. So let's do that one by one. First, let's look at net profit margins. This is our net profit. This is our revenue. So net profit margin is this much. So this is our net profit margin. Let's look at asset turnover ratio. This is our revenue divided by average total assets. So this will give us asset turnover ratio. Lastly, we have equity multiplier, which is average total assets upon average shareholders' equity. So first we'll take average of total assets then we'll take average of total shareholders' equity. Just checking on the average total assets part. Yeah, correct. So here we have average of total assets and average of shareholders' equity. So we can get equity multiplier as this, and then we can multiply net profit margin into asset turnover ratio into financial leverage to get our return on equity. So this should match with this ideally, right? This was a direct way of calculating ROE, and this we have calculated through multiplication of three different ratios, and the answer should be same. So this is what we call as Dupont analysis of ROE. Now we are seeing ROE is going up, but Dupont analysis can now tell us why ROE is going up. Is it because of net profit margins? No, net profit margins are have in fact gone down. Is it because of asset turnover ratio? Yes. Is it because of equity multiplier? Yes. So the major components of ROE going up are higher asset turnover ratio and higher equity multiplier. Asset turnover ratio going up is a good sign because that means we are able to generate more revenues using our average total assets, which is positive sign. But equity multiplier going up, average total assets upon average shareholders equity, that is not a good sign because that means relatively proportionally the company is relying more on debt financing as compared to equity financing. So that's why equity multiplier is going up, which can make the firm risky if debt goes beyond manageable limits. But for this company, we have seen that debt is well within limits with a very high DSCR, with a very high interest coverage ratio. So debt is the level of debt is not at all a problem. So even if financial leverage or equity multiplier is going up, still we are very sure that debt is still very much at the manageable level. So uh, within those limits, there is no problem. So um, it's a good sign that overall ROE is going up, majorly contributed by increase in asset turnover ratio and little bit contributed by increase in equity multiplier, uh, which is not concerning as of now, equity multiplier going up. So overall, the company is doing better as it is moving forward. Let's look at return on assets. Net profit upon average total assets. Return on equity assets will be net profit upon average total assets. So calculating it again, net profit upon average total assets. So like this, we can calculate it for all the years and we figure out ROA is going up, which is a good sign. Company is able to more efficiently use its total assets to generate higher profits. So more operationally efficient it is becoming. That's why return on assets is going up. Again, we can break down ROA also into uh, different components, net profit margin into asset turnover ratio. That could be the Dupont analysis of ROE. So here we have net profit on revenue. This is our net profit margin. Okay, so this is net profit margin. Then we can look at asset turnover ratio, which is equal to revenue upon average total assets. Which will give us asset turnover ratio. Calculating it again, revenue upon average total assets. So this gives us asset turnover ratio, and if we multiply these two, net profit margin and asset turnover ratio, we'll get our return on assets. Okay. So through this Dupont analysis of ROE, we can figure out what is making ROA go up. Clearly, it is the asset turnover ratio. Asset turnover ratio is increasing significantly, which is resulting in the ROA going up. So it's a good sign. Company is able to generate more revenue, more profits using its total assets.